5:30 Central Time, right on the hour, and I wanted to say good afternoon or good evening to those on the call, depending on where you're dialing in from and what time zone you're in. This is our first kickoff call of the year, and we're really excited to have one of our strategic partners, Brad Angel, with Fidelity Investments, with us today. Brad's going to talk a little about, he's been a great partner for several years, as some of those on the call may know. And Fidelity is one of our premier partners in terms of our wealth management and our data collecting, quantified and qualitative analysis. So they do a lot of really good analyzing of securities, positions, funds, and Brad's just overall really good guy too. So a great resource for our team. Brad, thank you for being here. I wanted to just quickly introduce you and welcome you to the call for clients and partners of the Equitable Private Wealth Group. Without further ado, let me pass it to you, Brad. We really look forward to hearing about 2024, but most importantly, looking ahead and seeing what 2025 has in store for us.
Thank you, Andrew. Great to see all of you. I really appreciate the friendship and partnership with Private Wealth Group and for everybody joining tonight. Anytime I have these conversations, let me turn this light off. I'm dealing with pure darkness here, and I live in the Dallas area, and we're dealing with snowmageddon here. So my lighting is an issue, so forgive me, y'all. But anytime I have these conversations around, market outlooks and equity perspectives and things like that, I always like to start with some perspective around what we should expect as investors. And I always say, look, I mean, the opportunity, the long-term average of the U.S. equity markets is 10%. That's pretty good. In order to get that 10% average return, however, we have to understand that volatility goes along with that. And so you can expect corrections, three corrections of 5% pretty much every year. You can expect a 10% correction every year, a correction of 15% or more every 3 years, and a correction of 20% or more every 6 years. Now, that's typically the cadence of recessions. And quite honestly, in the last 6 years, we've had 3 times that cadence. If you think about it, 2018, we were down almost 19.6. I'm going to call it 20%. That's a bear market. September to Christmas Eve, 2020, we were down 35%. 2022, we were down 18 for the year, but we bottomed at 25%. But the stock markets blossomed during that time. In 2019, we were up 32%. 21, we were up 25. 2023, we were up 28, and last year we were up 25. So really, the whole point in me telling you all of that is staying the course has been the right course of action. If you'd invested $100 in January of 2018, you'd have over $250. So you would have doubled your money. And I think the ultimate thing is that's why you work with professionals like my friends at the Private Wealth Group to, keep you invested in the right allocation. And I know, I work with a lot of advisors and they're as good as anybody in the business. So I just kind of want to start with the base case that we see in terms of our outlook is one of economic resilience. So if you kind of look at the, left side under base case is one of economic resilience. We see very few signs of recession or any kind of protracted downturn. Corporate fundamentals remain strong, and that stronger economy is translating into broadening earnings growth, which is good. I'm going to talk about that in a minute. Labor market and inflation have come back to balance, and the Fed has begun to normalize monetary policy. Anytime you see the Fed cutting while the economy is still in growth mode, that's a good thing. They're cutting rates because they can, not because they have to. And, you hear a lot of talk about the soft landing, that's intact. So what's soft landing? Where they're able to bring inflation down with any kind of labor impairment to speak of. And so the big question is, look, is that running out of room or is it just beginning? We're up 65% off our October 22 low. Um, and so the only other kind of, if we look historically, what's something to compare it to? The only other soft landing to compare that to is 1994. That's the only one that had any kind of duration, and that was 50 months with a run up of 144%. That's the only analog that rhymes. Greenspan had tightened rates from 3 to 6%. So he was raising interest rates in 1994 due to inflation. He paused in 95 because inflation had come down. And he only cut 3 times. He went from 6 to 5.25. So when the Fed cut in 1995, corporate earnings were growing. Corporate earnings are growing now. Again, I'm going to talk about this. And look, we have, whether you like them or not, a pro-business deregulatory agenda that's coming out of Washington. Um, and so, look, maybe we're done. Maybe the Fed's done. Maybe there are a couple of more. Right now, there's no reason for them to cut rates. So I'm going to talk about all of that a little bit more. So, if you think about like the way we're putting things in perspective, the 3 R's. And really the middle one is our base case. I'll start far right, mild recession. Look, I can tell you, we don't see any recession if we just look 12 months out. All right, we're looking 2025. We don't see a recession. Now, anything can happen. We don't see it. You know, base case is going to be that middle R, resilience, maybe slowing growth. I don't think expectations, look, as I said, we did 25% on the S&P 500 last year and 28 in 2025 with valuations or the stocks are pretty expensive right now. Can we grow that level? Maybe not, maybe temper expectations. Um, but I think, as we look, that's kind of the base case is that we continue to grow. It moderates a little bit. Inflation's going to be stickier. That last little bit of getting rid of inflation down to the Fed's target of 2% is going to be, tougher than many expect, in our opinion. I would say the reacceleration is probably one of the things that concerns us. Oops, sorry about that. Can we see reacceleration with an administration, again, that's promoting a deregulatory environment? Deregulation is typically good for profits and good for the stock market. And could that lead to higher inflation? If the economy reaccelerates to the point where the Fed stops cutting and yields on the 10-year Treasury go above 5 and beyond, that could be a problem. So, you think about, okay, it's a good outlook. What concerns us? Let's get the bad news out there. That'd be one. Like, do we reaccelerate to a point that inflation kicks in and the Fed not only stops cutting, but dare I say, raise rates? We don't see that could happen. The other thing, valuations are rich. The market is priced to perfection right now, and obviously things are hardly ever perfect. The only time we've seen multiples or, stocks this expensive was, in the past 30 years, were 2 other times. One was right around the pandemic, and the other one was right before the NASDAQ imploded. So multiples can stay here, and look, they can go higher. And so the market is expensive, but that does not mean there aren't opportunities. Again, base case is resilient economy, growth continues and does just fine, fundamentals do well, and inflation, stays higher, but eventually gets towards the Fed's mandated 2%. Funny that I heard one of our analysts of all people kind of give this analogy, and I stole it from him, because people are saying, look, the market's done so well, can it go higher? And so he said, look, there was a song back in 1999. I'm an old guy. I remember it, by a band called Creed, Higher. And then I see you remember that song, Andrew? And he said, look, let's use the acronym Creed to kind of outline why, yeah, I think it can. And CREED as an acronym would be consumer, rates, employment, earnings, and then the last is diversification. So I want to just start with the U.S. consumer. Remember, 70% of our economy is driven by consumption, the U.S. consumer. Very, very important. And, regardless of maybe how some of us feel, consumer balance sheets in the United States are in good shape. Um, Household net worth is up 48% since the pandemic. If we look at that dark blue line there, that's showing us that disposable personal income has risen 30% since the pandemic. Now we have to subtract out prices that are up 20%. Okay. But we're in real terms, we're up 10%. That's pretty good. The other thing is, the Fed went on one of the most aggressive rate hike cycles in history, but yet it didn't really impair the economy. Why is that? Well, the US economy proved that it's not as susceptible to higher rates as it once was. A lot of that has to do with the fact, let's not forget, from '08 through 2021, early 2022, we were in a record low negative interest rate environment in some points. That's the anomaly. Like seeing higher 10-year treasury yields that we're seeing right now is more normal than seeing zero interest rate environment that we saw. And what that meant was US consumers, US households financed the biggest chunk of their debt on their balance sheet, their mortgages, at below 4% in many cases. Not only US households, but US corporations financed the majority of their debt in record low interest rates. So, as I said, the biggest liability on the US consumer balance sheet is their mortgage. That's 70% of US consumer liabilities. And if we look at that green line, that's um, mortgage delinquencies. Those are leveling off to below pre-COVID. As I mentioned, the average mortgage rate is under 4%. 40% of US homeowners have no mortgage. Now, the other part of this is revolving debt. That's only 8% of US household debt. Um, and if we kind of look at the blue line, auto loan and credit card delinquencies, they are rising. Okay. If you compare it to pre-COVID, maybe slightly higher, certainly not at levels that we saw in, '08, '09 or 2000. And I want to talk just a second about, credit card delinquencies, auto delinquencies. We hear that. I want to put it in perspective. If you look at the delinquency rate in 2019, I always kind of go back pre-COVID, was at 6.7. We're at 9.1, higher for sure. The nuance is if you kind of break that down into income cohorts. And so the lower income part of the ledger versus the higher income part of the ledger, where we're starting to see those delinquencies pick up, is in the lower part of that income ledger. Now, I don't want to be dismissive, okay, but I want to put it in perspective. If you add up the bottom quartile and second quartile, so let's just say the bottom half of US income, US household income, that makes up about 6% of overall US discretionary spending. So they're not really driving the majority of the spending, which drives our economy, and that's what we have to look at. So again, not dismissive, but trying to provide some perspective around that. So I want to talk about the second R in Creed, Andrew's favorite band. He secretly pulled me aside and told me not too long ago. Rates, and I'm going to tie this kind of into to Fed and inflation. But remember, the Fed has a dual mandate: full employment and keep inflation in check at their 2% target. And we can talk about, Fed funds rate and how they do that. Not to get too nerdy here, but, on December 18th, maybe we weren't paying attention. A lot of us had a lot of other things going on. But the Fed came out with their updated summary of economic projections. And some interesting things came out of that. Stronger economic growth. So if we looked at their September report, they said we'd have 2% economic growth in 2024. They adjusted that to 2.5. Honestly, that's probably a sandbag number. I think we'll It'll probably be more closer to 3. The past 3 quarters were 3. I think it's going to end up at 3 for 2024. Productivity is about 2% now, and it has been for the past 5 quarters. If we get that going forward, plus 1% population growth, that's 3% GDP. That's solid. And lower unemployment. So they're projecting, we had a lousy unemployment number in August. A lot of that had to do with some of the storms we were dealing with. But right now we're at 4.2% unemployment. I'm going to talk about that a little bit more in a second. So bottom line, economic growth is better, employment in balance, inflation up 2.3 to 2.4. So in terms of rates, what does that matter? Well, I think higher Fed funds rate than what we expected. Okay, we're at 4.5 now. They were projecting 3.5 by the end of 2025. Now that's at 4. So fewer rate cuts, bottom line there. And really, there's no need for the Fed to cut. Okay, there's no need to bring a fire hydrant or fire engine of liquidity to a building that's not on fire. The economy's in better shape, labor's not as weak, inflation is not coming down as quickly as they thought. So the Fed is cut because they can, not because they have to. That's a good place to be. No recession and the Fed is cutting, that usually means good things. If you look out 12 months past their first rate cut, that's averaged a 20% return. When rates go lower and profits grow, that averages 14%. Inflation, the Fed looks at core PCE. So you've got core CPI that subtracts out food and energy. That's at 3.3, obviously higher than their target. And you say, well, why do they back out food and energy? That's what I consume every day. Well, they can't, food and energy are very volatile. They can't base their long-term positions based on the volatility of food and energy. So you strip that out. CPI is what that is. That's 2.7. They use core PCE. This stuff gets in the weeds, but core PCE is more of a broader spending base. So bottom line is that's at 282. That's higher than their 2% target. It's not terrible. It's been all over the place. I mean, if you go back to the beginning of 2024, the market was pricing in 8 rate cuts between 2024 and 25. Then after the beginning of last year, if anybody remembers, we had some pretty red hot inflation numbers. It peaked at 10 rate cuts, then it came back down. I think the bottom line is the Fed may have, as of now, it's data dependent, maybe has 2 more rate cuts in them. And leaving rates at this level obviously hasn't hurt the economy. One thing that we're keeping a close eye on, if you look at the right side of this chart, it's a lot of stuff, but this is one thing that, you think about what could go wrong. This is it. And this is just showing, like, if you go back historically, if inflation hits 5%, all right, so if you see that line that's going straight up and down, green and blue line, green is historical average, blue is our current path. All that's saying is once it hits 5%, it moves up, it peaks, and then it comes back down. Here's what we're looking at. That green line historically, look what happens. Reacceleration, as I said before. That's the concern. Could the economy reaccelerate to a point that inflation kicks back in? Now we have to have a Fed that reengages. We'll see, but that's what we would be keeping an eye on. So that's rates. The first E in creed employment. And labor has cooled, but it's back in balance. And what I mean by that is we got to a point where we were at a 3.6% unemployment rate. We had 2 job openings for every person looking for a job. Now, while that sounds good on the surface, it's not really good from an inflation standpoint, because that led to 8% wage inflation. And you want to talk about what was keeping Chairman Powell up at night? It was that. And he even said, look, we have to kill job openings, not jobs, if we're going to bring inflation back in check. And they've done that. We're back in balance. We're back to a 1-to-1 ratio. Job openings are down to about 7.7 million from a peak of 12 million. And so I'd say labor's back in balance. And one of the things I want to say on employment, and that's a very important thing to look at. If people have jobs, they're spending money, that's what drives our economy. We oftentimes look at the unemployment rate and we get that unemployment number the first Friday of every month, looking back. That's backwards looking at the prior month. I think a better thing to look at is every Thursday is the job openings report. This is the unemployment report. You get 52 data points a year, and it tells you how many people have been laid off. That's a leading indicator. Get it every Thursday morning. If we would need to see this spike and stay spiked for a protracted time for us to be concerned about cracks in the labor market. It's been around 200,000, 220,000. If it gets to 300,000 and stays there for a while, that would get our attention. We're just not there right now. So that's E. Let's look at the other E in Creed, and that's earnings. And Andrew, did that switch over to potential broadening out from the Magnificent Seven?
It did. We saw it for a minute there. Improve
Um,
margin, provide
yeah,
market optimism. Yep.
perfect. Okay, so look, these slides are busy. We like to put a million different things on a slide. So just kind of look at the left part of this slide, and that's what's important. Uh, Earnings. So 2023, let's not forget, earnings recession. Earnings on the S&P 500, -3. This year, 2024, we're in earnings season now, projected to be 9% earnings growth, pretty solid. 2025 projected earnings growth for 2015 or 2025, 15%. Okay. That's good earnings growth. Stock prices follow earnings. And I think that this will kind of give you a sense of some of the sectors and how they're looking to perform. You've got industrials, comm services, and tech and healthcare kind of leading the way. But I think what you're going to see is a broadening out. And what I mean is, everybody's heard the Mag 7, right? The biggest seven have really been leading the way in terms of earnings growth relative to the other 493 in the S&P 500. And what I'm showing you, those green bars, earnings growth relative to the blue bars, the other 493. Outsized earnings growth relative to the rest of the cohorts within the S&P 500. I would just kind of point to you, though, as we look at kind of the first quarter of this year into 2025, you can see how that kind of levels out. And so we should see earnings growth start to grow for the other 493, mid-sized companies, small-sized companies. Look, the Mag 7, okay, they should have a good year, but probably not as good as last year. Earnings are decelerating there. Last year, they had 33% earnings growth, projected to be 21% this year. Still really good, but that multiple really hasn't re-rated downward. So they're still kind of high. And so they need to kind of move down a little bit. Compare that to the broadening of that rally. Small cap earnings accelerated from 8% in 2024 and are expected to go to 21% this year. So if you think about that, 33 going to 21, 8% in smaller size companies going to 21, and you pay 15, 16 times earnings on small companies versus 33% on the Mag 7. So that's just a long way of saying that should broaden out, and that's why it kind of leads to the D in Creed, diversify. That's why you work with the pros of Private Wealth Group. We do believe in diversification. A lot of people have kind of gotten overweight large cap growth. We like it still, but there are opportunities out there that are maybe less expensive you might want to consider. So just want to touch on a couple of last things. I think we're at 5:55. Just a couple of other quick things I know are on people's mind, about the election. We've gotten a lot of questions over that. We need to update this, right? We need to up this to a Republican sweep. So this is a little bit dated, but I think you can see that the next 2 years, you average 12.2%, really good. Okay. But I would just kind of point out on the right side, next 4 years, it doesn't really matter. It kind of all averages out and ends up being pretty even when it's all said and done. It's about profits, not politics. Okay. And that's the main thing. Big concern about trade right now. That's the big concern is what are these tariffs going to mean? And media is kind of taking the 60% Chinese tariffs that have been thrown out there. These are proposals, they're not in place yet. And the 10% rest of the world proposals, and they're combining the two. So if we kind of look at the China portion of this, I just want to paint the picture of what does this look like if this happens? So today's tariffs on Chinese imports average about 20%. We import 440 billion worth of goods from China. All right. So if we go from 20 to 60%, so that's 40% of 440 billion equals 184 billion. And that's assuming that none of these tariffs get absorbed by supply chain, between manufacturer, wholesaler, retailer, consumer. Also assuming there are no exemptions. So the worst case scenario is 184 billion worth of tariffs. We've have a $34 trillion economy. That's 1% of GDP. 1% of GDP rather would be 340 billion. A lot of numbers. That's 0.5% of GDP. Okay. So long way of saying, even if the worst case scenario on Chinese tariffs would be 0.5% of GDP, now we import 2.6 trillion from other economies. So 10% of that would be meaningful. Look, these are opening salvos. I don't want to go off on my tangent. These are opening salvos. None of this has been implemented. Negotiation. That's kind of where this thing is right now. But that's going to be an uncertainty overhang until we get some clarity. The market doesn't like uncertainty. Will there be an extension of the Tax Cuts and Jobs Act? We'll see. But you can't increase the budget deficit in Congress unless you have a supermajority of votes. So you have to have 60 in the Senate. Right now, Republicans have 53. So it's going to be tough to increase the deficit. And that keeps those guardrails keep the deficit from ballooning. Last thing I'll say, Doge, I'm excited about it. Like if we can get more efficient, who wouldn't want that? But remember, 61% of our budget's mandatory. We're paying 13% of our budget on interest payments alone, the same as our defense budget, which is 13%. There's only 13% left. So they don't have a big pool to work with in terms of cost cutting, but we'll take what we can get. So a lot of stuff there. I would just say, we're really still constructive on the U.S. economy. Is it going to be as robust as the past 2 years? Maybe not. But corporate earnings growth looks good. The fundamentals of U.S. corporations look good. The U.S. consumer looks good, 70% of our GDP. And we have a pro-business deregulatory administration coming in. All of that looks good. What would concern us would be reaccelerating to the point that inflation kicks back in. Valuations are rich. That's concerning. And higher interest rates wouldn't be great.
Well, thank you so much, Brad. You never cease to amaze me how you were able to tie in a band from the 90s and 2000s into a financial topic. So I think that was quite impressive. Just a quick question. So, we've been fielding some questions. You mentioned a couple things. The market has celebrated its 2-year birthday of a bull market. We didn't, we saw things kind of slow down toward the end of the year. We didn't get the Santa Claus rally that some people expected, albeit markets still returned very positive numbers. We did see Fed's lower rates. However, 10-year treasuries are actually still up due to the economy and how strong it still is. So can you speak to maybe, those that are looking to perhaps get a little bit more defensive? I mean, portfolios have recovered from 2022 lows for the most part, and certain sectors that will still give us access to markets, but be a little bit more on the defensive side. Is there certain areas of opportunities that you or your team see that, if we were looking to rebalance, might be some attractive areas if we were looking to de-risk some of the portfolios?
Sure. I mean, you have the kind of classic defensive sectors of consumer staples. Utilities is an interesting historical defensive sector that is also a derivative AI play because of the power required to fund these AI data centers. Healthcare, I don't know if you saw, if I can, healthcare, again, historically, defensive sector, but projected earnings growth at over 21%, has kind of been a laggard. And I think you do need an active manager there because, big pharma, we're not really excited about, but there's some innovation in that space. So I think some of those historically kind of defensive sectors can work. From a fixed income perspective, bonds should act like bonds again. You don't want to use your risk budget in bonds right now. In other words, if you would be kind of level duration with the Barclays Ag, which is kind of the S&P 500 for investment grade debt, you're getting a great yield with very little downside. You can even cut that duration in half if you wanted and still get a pretty good yield with lower downside risk. So kind of that low duration to even with the ag. Bonds at yields at this level should zig when equities zag. So if you're concerned about market volatility, when really high inflation, if you remember 2022, bonds were down 13% and equities were down 20 something percent. That was the worst year ever for investment grade bonds by a factor of 4. But I think that's behind us. And so owning high quality core bonds, those traditional kind of defensive sectors, quality in large cap, durable earnings growth, clean balance sheets, all of that should do really well. And you mentioned opportunities. Last thing I'll say, that's why diversification is part of that conversation to say, yeah, we like large caps. They should continue to do really well. But also look at the earnings growth in small and mid cap companies. That's an opportunity because their earnings growth is expected to be much higher than large cap and their valuations are much lower.
Yeah, that's really good context. Brad, thank you for always being a great resource to our team and to our clients. I think that's a good segue. Just to sort of wrap up, we promised we'll get everyone out of here by 6:15 for those sports fanatics, just enough time to level set and watch Penn State and Notre Dame. I think they come on at 6:30 Central. But Fidelity's played an integral role in how we manage money on our private wealth team. Part of our investment policy that I want to share with our clients, and some of you may have heard this, some of you may have not, but really, number one, it starts with maintaining objectivity and making sure that we always fulfill and our clients' best interest. We are upheld to a fiduciary standard, as you all know, and every plan that we do and offer advice on is authorized by an in-house certified financial planner. So maintaining objectivity and tapping into the best resources, that be Fidelity's, Morningstar, you name it, the best research out there so that we can get direct thought leadership integrated into the portfolios. Our second core competency, of course, is just we strongly feel that markets are efficient. We don't buy fundamentals. We buy fundamentals. We don't buy trends. We prioritize long-term discipline investing, and we do believe that current securities, where they're priced, do represent fair values based on all available information. We've also learned that, we acknowledge that markets go up and markets go down. Brad kind of talked about it. Market volatility is the price that we pay to grow wealth. And markets are extremely efficient of transferring wealth from the inpatient to the patient. And so we try to stay attuned to that. And instead of shying away, rather figuring out and navigating through market cycles so that we can come out advantageous on the other side. We also have a strong conviction of domestic over international investments. The United States plays a significant role in global innovation, competition, and monetary policy, and we expect that to continue to do so. Leading back to our large U.S. company conviction, we do believe that large established companies that have strong balance sheets do tend to overperform in the long term, those that are not over leveraged and have a track record of long-term cash flows and dividends. I would also say that a core conviction is that costs matter. Costs matter, whether it be investment management cost, tax cost, opportunity cost, the cost of investing or the cost of not investing. One of the most challenging things that we do as financial advisors is controlling expectations and making sure that our clients don't ever invest because of greed or fail to invest because of fear. And so we are always cognizant of any of the cost drag on portfolios, again, from all the different facets. We do tend to lean toward passive versus active management for that case, but we do have some conviction where active managers do provide the value to the overall portfolios. So I wanted to share just some of our core convictions of our investment policy statement. Wrapping up on the comments here, I meant to mention this at the beginning, but we wanted to send wishes and prayers to our friends, colleagues, and clients in California. We're thinking about you all. We also want to acknowledge the fact that we had a great year in markets last year and as a firm. And so we want to thank those clients and those on the call today that have come along the growth journey with us. We could not do what we do every day without you and doing what we're passionate about. So we're extremely thankful to have you alongside us and our continued partnership going forward. We are opening up to taking on new clients in 2025. If there's opportunities where you feel people need help and don't know where to get it, we're always open to a conversation to see if there's some value that can be added. So with that said, we promised we'd get you out of here a little early. I hope this was beneficial. Be on the lookout. We want your feedback. So if there's subjects that you want to hear, you want to know about from the quote unquote horse's mouth and be able to decipher what's fact versus fiction or what we hear or read or see on media outlets, feel free to give your financial advisor a call. If it's something that we can loop into a call like we broadcast here that's available to our clients all over the country, we're happy to do that. We're also happy to bring on additional research partners. Fidelity and Brad have been, as we mentioned, a great resource. We also have other distribution and research teams from companies as iShares, Vanguard, Invesco, et cetera. So we want to make sure that we can give you timely information and things that are pertinent to you in scope of what's going on around the world and economic conditions. So, in closing, I'll just say, it's never paid to bet against America, and we come through things, not always a smooth ride. We don't know what's going to happen next year, but we're going to be alongside and a voice along the way. So we strive to always be an investable voice for you, your family, your business, and your investments. And we look forward to a prosperous 2025. Please feel free to reach out to us anytime. And you guys have a good evening and have a good afternoon.
Take care, y'all.